Well, look, I want to talk a bit about global financial reform, and I should begin by saying why is it important that we should think about it. And the reason is, of course, that the entire global financial reform agenda arose out of the global financial crisis in 2008. And you'll recall that global financial crisis was the greatest global economic calamity that we had experienced since the 1930s. We got through it here, but Europe and the US went into very deep recessions, and we are still feeling today the effects of that event. Well, in the immediate aftermath of the fall of Lehman Brothers in September 2008, the sense of emergency in the global economy was sufficiently sharp that the G20, which had been formed some years before, elevated itself to a meeting of leaders, which hadn't hitherto happened. And in November, in Washington, meeting there in the ruins of what appeared to be a collapsed global financial economy, one that was paralysed with major financial institutions refusing to deal with each other, they commenced a program of global financial reform, recognising that global finance simply could not continue in the way it had. It simply could not continue. And it adopted a number of important objectives in this agenda. One was to increase the requirements on banks for capital to meet emergencies and liquidity to meet emergencies, so that they could be better able to withstand downturns in the economy and runs by depositors. They could be better able to withstand this before they had to turn to governments for support, because the other great calamity for governments in the wake of the financial crisis was the trillions that they had to spend propping up the global financial system, and particularly in the UK and the US and Europe. So one thing was to make banks more robust, but a lot of the problems weren't in banks. Lehman wasn't a bank. It was an investment bank. It was not regulated by the Fed and only very lightly by any other agency. And its activities were not so much lending to individuals that went bad, but buying very difficult to understand financial instruments, derivatives that bundled up obligations in the mortgage market with credit default insurance in ways that became very hard to interpret and therefore very hard to sell. And they bought these instruments using money lent to them overnight by US money market funds. So as soon as there was a question mark about the assets being held by Lehman, the money market funds withdrew their lending and the house of cards collapsed. So the other agenda was to extend the regulatory net to investment banks or indeed the entire shadow banking system, certainly in the US and Europe and the UK, and exercise greater scrutiny over the kind of transactions. A lot of the risks were arising in derivative markets, and these financial instruments were sold over the counter between different banks. There wasn't they weren't exchanged in open trading forums. So part of the agenda was to try and create an open trading forum for as many derivatives as possible. So those were the sorts of things that were agreed in the Washington Summit and Pittsburgh and London summits which followed. And it's interesting to, I think, reflect on now, 6 years later, what has been achieved. And it's interesting for three reasons. One is, do we have any assurance that we're not, on the brink of another financial crisis like that? What has it changed sufficiently to mitigate that risk? But secondly, what's it tell us about the effectiveness of global economic cooperation? After all, in the last decade or so, most forms of international economic cooperation that we had become used to have failed. We haven't been able to get a new trading round, for example, in the World Trade Organisation, the Doha round, going nowhere after 14 years. The IMF, the governance of the IMF, we've wanted change. In fact, Australia's been in favour of change for at least a decade, and nothing's happened, primarily because the US doesn't wish to concede authority, and nor does Europe. So there are lots of areas of global economic governance where we haven't been able to make much progress, and Kerry, I thought, very articulately described another, international tax arrangements. But this area of global financial reform seems to me the key test, the litmus test of whether this kind of arrangement within G20 is worth pursuing. Its actual pursuit didn't really, is in a sense nominally within G20. The main executive arm of pushing the agenda forward has been the Bank of International Settlements, and within it the Basel Committee on Banking Supervision, of which Australia is a member. This is a group of central bankers and other regulators, and it's their job to pull together the various proposals for global financial reform and present them to another forum, which is the Financial Stability Board, which is part of the G20 and which reports to it, and which late last year took the view that the Brisbane Summit will substantially complete this epic of global financial reform, which commenced in 2008 in that crisis. Well, what's been achieved? And let me summarise it briefly, that a huge amount has been achieved in respect of banks. Not surprisingly, given that the BIS, the Bank of International Settlements, is traditionally concerned with banks. And the main vehicle for change, which is called Basel III, the Basel III Agreement, builds on Basel I and II, which also emerged out of the BIS committees. And the main change, I think the regulators would say, certainly our regulator would say, has been to increase somewhat increase, not by very much, but to somewhat increase the banks' capital, the capital that they're required to hold, but more importantly to change the nature of that capital to have a much higher component of equity rather than debt or debt-like instruments as part of that. And that equity, that Tier 1 capital, which has been increased, its equity component from 2 to 4 as part of Tier 1 capital is available as a buffer when loans go bad. That's one big change. Another big change is to impose a leverage ratio on financial institutions, and particularly banks, of 3% of capital against their unweighted assets. There have been agreements, not yet implemented, but probably will be implemented, and certainly I hope would be getting some encouragement from the G20 meeting in Brisbane to impose somewhat stiffer requirements, an additional 2% of capital, for example, on globally significant or systemically important global financial institutions, that is the major global banks in particular. As I said, agreed but not yet executed. There's been much less progress on some of the other outstanding issues that arose in 2008. There hasn't been quite as much progress on finding global rules on shadow banks, although the US has made a lot of progress on bringing non-banking institutions that operate like banks within a much more detailed regulatory net than existed prior to 2008. The US has made very important progress in that respect, and as has the UK, and Europe is heading in that direction. There's also been less so far in derivatives, in moving derivatives onto to public exchanges, but there has been some progress, and there's certainly been a very marked reduction in the risk appetite for derivatives on the part of global banks. So there are certainly very important advances to celebrate. Within the G20, there's a great deal more to do. I don't think that, as Chair, Australia can accept the proposition that the reform agenda is substantially complete, and in fact I would imagine that quite a bit, particularly on shadow banking, on derivatives, on how to wind up institutions that are considered too big to fail. All those things have to emerge out of the G20 in Brisbane, and Australia will, I think, be expected to contribute some policy guidance to that outcome. Well, let me just conclude with the question which started the whole reform agenda, the biggest, I think, global economic governance change of the last 6 years. What started off in that is the world now safer? And I think in some respects it is. Banks have bigger capital buffers, or will in a few years. They're constrained by leverage ratios, which are tighter than they were a few years ago. Globally, systemically important banks will soon have capital requirements that are bigger than those of other banks. So in all those respects, I think we've made very great progress, but it would be a great error, I think, to imagine that crises can't recur. Banks, after all, borrow short, lend long. They have, for all the additional requirements, relatively thin capital buffers. There's always a crisis waiting out there. And that means that, to my mind, that the other great principle that Australia ought to be advancing in Brisbane on this crucial agenda item is the necessity for continuing regulatory scrutiny globally of our financial system. Thank you.